Welcome back to the podcast. My name is Shay Phillips with the Tahoe Real Estate Insider. Today, we are joined by Brad Buxton, Senior Investment Agent with Address Income. Brad, thanks so much for joining.
Thanks for having me, Shay. I like being a regular guest on this podcast.
You're always a great one. Today, we're going to talk about whether or not it's a great time to buy. Right now, it's a buyer's market. Things are a little bit uncertain in the overall economic market. So this conversation, not only is it good for today in this market, but what we're also going to talk about is kind of the things we look at during different markets in general. So this is a conversation that can go and be relevant in any market. So Brad, I know you get a lot of questions as an agent. Hey, is right now the time to buy? Let's start by talking about where things are at now and what people are concerned about. So what are you seeing on your end whenever you're dealing with home buyers currently?
I think let's actually step back and what makes something a buyer's market. It kind of depends on what kind of asset you're buying. Also, usually people generally think of a buyer's market when you're already deep into a buyer's market, which usually means that prices have come down. There's a lot of seller concessions. There's a lot of inventory on the market. Things like that kind of make it a buyer's market, but you don't really recognize them until it's deep into a buyer's market. So there's different strategies that people use if you're an investor versus a primary home buyer. Primary home buyers, generally they move because they either have to or they maybe just want to, and they have the capital and funds to do it. Where seller's market, you kind of recognize that, later when you're like, oh, that was the peak of the market. Obviously a seller's market, because during COVID, it kind of peaked 2021-ish, 22. And you can look at that data and be like, oh, that was a seller's market. People were getting the highest prices. But sometimes you don't know you're in a seller's market until after a drop happens. Because if prices just keep going up and up and up, then it's like, oh, look, what a great time to buy. So that was obviously a buyer's market. So if that, trend continues. So it's kind of an interesting thing, and it really depends on what asset type you're buying or which type of property you're buying on that. And that'd be another podcast topic, whether homes are an asset or a liability. So
Yeah. Well,
we
would you
get into that
consider,
later.
yeah, that could be another one. Would you consider a buyer's market whenever prices are appreciating or depreciating, or would you consider a buyer's market whenever it's more competitive to be a buyer versus less competitive? Because during COVID, it was extremely competitive to be a buyer. There were multiple offers going out on a single property within days of it being listed. It was really tough to get into contract on something. What do you consider a buyer's market?
Well, that was a great time to buy. So it was at a buyer's market with interest rates super low. So maybe that was a buyer's market. I mean, I
That's a
think
good
the
point.
question always comes down, and a lot of people, and a lot of agents say this too, is that if it's right for you, it's the right time to buy. So that's still the underlying fundamental of it all. I mean, if you have, if you own a van down by the river, which is actually really expensive, that might actually be, mean you're doing pretty well, but you're not interested in buying, you don't need to buy a house, you don't want to buy a house, then there's no reason to buy one. Or versus hey, you both just lost your jobs, maybe now is not the time to buy a house. I mean, if you're financially stable, willing to take that risk, have the time, energy to put into the home buying process, then you can buy a place. And I think the reason people say that is that oh, it's always a good time to buy. It's if you plan on holding your either your investment property or your primary residence on a long enough timeline, it's always going to appreciate. I mean, even if you bought in 2006 at the peak market, just before the crash there, most people got back underwater in 7-8 years. But can you hold off for that long, right?
Right.
During
Can you
2008, if
weather
you
the
lost your job,
storm?
can you weather that storm for that long? Because if you did, and you bought a house in 2006, I mean, it's probably at least doubled. So you bought a 500,000, you probably have $1 million house. Um, yeah. It depends on your timeline horizon and your exit. So we kind of have two types of buyers. Really, actually, three types of buyers. There's the uh, single family home buyer. Actually, maybe even four. We're getting all kinds of categories here. So you have your single family home buyer, somebody that's like, hey, I just want a place to raise my family, a nice place to live, and I'm going to be here forever. So it's like, I'm going to live in Tahoe forever. I'm going to buy a house. It stretches my budget, but I know I'm going to be here forever no matter what. I'm going to make it work. I'm going to, pay that Tahoe tax to live in Tahoe. So then it's like, yeah, great, do it. If you're an investor, there's a couple types. Some people buy multifamily, whether small, under, 2 to 4 units, or 5 and above. Buying multifamily right now is kind of interesting because there's a lot of sellers. There's actually more on the market in Reno than there's been maybe ever. Usually there's around 50 properties on the market. Now we're up around 100 multifamily properties. And so sellers aren't coming down on their prices. And a lot of them have owned it for a long time. So there's just sitting. So the buyers are looking at the numbers and it doesn't make sense. And right now we have kind of the standoff or a frozen market. So it's not a buyer or seller. We're just at this
Sellers aren't budging on price, but buyers also aren't willing to go up to the price. So there's good old fashioned standoff happening.
standoff. Yeah. It's like the Old West. Who's going to draw
Right.
first?
Exactly.
The end of the year tends to be a little bit different. Then you have larger multifamily buyers, and similar things are kind of happening that maybe they got a loan, maybe they're underwater on it a little bit. They can have some holding costs hoping that the market's going to go back up and that someone will give them a little bit more money for it. So, um, and then you have people with commercial properties. I think that's a lot of the stuff you might see in the news about a housing crash, uh, or a real estate crash sometimes. I've seen it posed as that. I think it's really clickbait. And it's really commercial loans or people that took out these 2 to 3 year loans, especially like syndications, which that's basically like a bunch of people buying a property together. The syndications, they got 3 year loans, but have a 5 year payout. So they're hoping to like refinance. But a lot of those are starting to, get underwater. They got a loan in 22 or something, and now it's coming due. So,
Yeah.
um,
Those adjustable mortgages can be, when they come due, they can be a nightmare, especially if you got them during COVID, during the low rates, and then now you're having to refinance out of them at triple the interest
yeah.
rate. It's
Yeah.
not
And most
great.
commercial stuff is short term loans. Like rarely do you get a 30-year loan on a 500 unit apartment
Right.
complex or something else.
Yeah,
So
that's
it's
gonna
like,
definitely be shorter
um,
term. So what I'd like to transition into is buying in a market such as today where there's some uncertainty in the overall economy. But before we do that, I just kind of want to surmise what we were talking about. It seems to me that what you're mentioning is, as a buyer in any market, if you're someone that's needing to get into a home, whether it's, you're raising a family and you just know you're going to be in a certain area for a long time, or whether you're buying a step up home, maybe you had your first home and then you're looking to buy an upgraded home because you're growing the family, or you just want some extra space, or you want a different area, things like that. Interest rates and the overall market are not as relevant in the conversation. But if you're somebody like an investor who's looking at the bottom line, this is a totally different story. Would you say that's accurate?
yeah, it's also, there's each market is going to be different. Uh, like Tahoe has seen a lot of price drops, especially up here, like in Incline Village. And it's going to naturally have probably more swings in a place like Reno that has, or even Carson City that has a lot more inventory to kind of balance that out. And stuff still sells. I mean, if it's priced at 400 to 500,000, there's still some good transactions going on in Reno too. So stuff's still turning over. New builds are still going. It really depends on the specific market you're in. A lot of the news stories that you probably hear are like Austin, Phoenix, a lot of the Sunbelt places where during COVID they just built and built. There's a lot of apartment inventory, a lot of starts, so they just bought tons of land. There's tons of apartments available, so that's driving rents down as well. But a lot of people are still like in they call them the golden handcuffs, that they're tied to this 3% interest rate. So, But yeah,
You'd like
depending
to
on what
move,
market
but
you're in. Yeah,
sorry, go ahead.
yeah. I was gonna say if you used to live in Austin, Texas, and now you got called back to the office in the Bay Area, you're gonna find the Bay Area is starting to be more of a seller's market right now, especially for renting and things like that. Like prices really dipped during COVID, everybody left, but now with the big call back to the office, and California is still a nice place to live, as most people like shit on California about whatever reason. It still has some of the best weather in the country. Um, there's a lot of cool things to do here. There's a lot of outdoor activities. There's a lot of arts and culture. So there's a lot of reasons people still, pay the extra tax and, you know, whatever political side you're on, there's still different reasons to live in California versus like a place that gets like super cold. There's like weird bugs. It gets super hot, super humid. There's no ocean. There's no beach. It's just like I don't know.
California's got it all. So, touching on transitioning into the current market, what we're seeing in the overall economy, and I know there's different. So, like you said, the Bay Area is going to have it's a little bit more of a seller's market right now. More people are coming back to the office, more people
Yep.
flooding into the cities. That was opposite of what was happening during COVID. People were leaving a place like Reno. What are you seeing boots on the ground in Reno right now?
Got a lot of inventory comparatively, in the last 5 years. There's still those people stretching for prices. We've gotten some really big price concessions recently. I mean, 10, 15%. Uh, and it's the way, and it's kind of part of the structure of real estate and how things get priced. So it's like, oh, that one sold for this much. So that means this house is also going to sell for that same much. Call them comparables or comps. And if you look back even 6 months, 8 months, I mean, I guess we're into November now. So if you're, yeah, probably, yeah, early spring, prices were good because a lot of stuff comes on the market in spring. So, sometimes the better time to sell is like early spring, like March. But what we've seen is so much came on the market, there was a lot of options for buyers. There was no urgency. And because of that, people were pricing their stuff. They would always like, oh, I think it's worth, 650,000. Let's put it like 675 and see what we get. It's pretty close, and then maybe they'll take a concession. So that's where like pricing becomes really important. You can look at some of the data to give you sort of a ballpark, but then you really have to look at, what sold yesterday, what sold last week, what sold within the last 20 days, and why did it sell? Did it have a view of the mountains? Did it have a big lot? Did it have a park for kids inside the house? So you really have to look at that stuff. And what happened this year in Reno is that people really pushed prices, and then they were so surprised that their house is sitting on the market. And because of that, we saw some great deals. And I mean, we put some offers on stuff. It's like, hey, we think we need to bid this price, looking at the numbers. And we put the offer in, and there's two offers that came in at the same time. So ours and another one. And of course, the other one was, like 30K higher, but it still goes to show that like they were ready to take our offer, but somebody felt the timing was right for them as well. So, uh, I mean, I encourage people to put offers in that are what I say book rate, which is more like someone's not going to look at an offer if it's a, $700,000 house or duplex or something, and you offer 500. Probably not going to go. You still have to look at what someone else might be willing to pay. So if we're bidding against each other, we can see that, you're going to put yours in, I'm going to put mine in, but maybe I have a little bit more I can put on the down payment. So I think it's like, yeah, I'm going to hold this for 5 to 10 years. And you're like, well, I just want to, flip this in the next year. So your offer is probably going to be lower because your timeline to exit is shorter. So there's still deals out there for sure, new builds. But that's kind of what's going on in Reno right now. I mean, it can be a buyer's market out there, but also, I mean, there's people that still do a 1031 exchange, which is a way to move real estate without being taxed capital gains. And there's people that will buy stuff in cash because there's a timeline on that, so they have to. And it's like, whoa, that sold for that much. It's like, yeah, they just needed a place to park their money. They ran out of time, so they ended up paying a little bit more than somebody that's, they're an investor. They want to get a great deal. So, that can affect the market as well. So
Certainly. And what we're seeing on our and I'm on the mortgage side of things. We do 40% of our business in Reno and Carson, and then the other 60 in Tahoe. But as a buyer right now, I mean, now is a fantastic time to get sellers to pay for closing costs, to help you buy down your rate if you'd like. There's so many creative ways you can structure a deal right now that where the buyer has leverage to help reduce costs. And that's one of the great things about the market we're seeing right now, being a buyer's market. So
yeah.
transitioning into
Well, let me touch on that real quick, Shay. I had a question yesterday. Someone's like, "What's a seller credit?" And I thought that was actually a good question to address because I think you and I probably do it a lot where we throw a lot of jargon around like the interest rates and the
it's a good point.
CPIs and things like that. So a seller credit is really it still comes out the net same. So if you're buying I don't know what's our price point that we should use for people.
Let's use 500,000 as seller credit. And sorry to step in here. A seller credit is just money the seller is giving you to help pay for your transaction costs as a buyer.
Right.
So
And
the
so,
seller
but you could
credit
also
come
lower the purchase price at the same way. So that's what I was trying to get to is that a seller credit can either, they can give you a $10,000 credit and they still end up with 490,000, or they can lower the price to 490,000. So what's
correct.
the
If you don't
pros
need
and
the
cons
credit,
of that?
right? As a seller, they're just looking at their bottom line. Hey, how much am I going to net out of this transaction? That's the number I want to hit. We can raise the price and give them more money for closing costs, or we can lower the price and give them less money for closing costs. So
All right.
thanks
Yeah.
for
So the
stopping me on
advantage
that.
to the advantage to the buyer is that if you get a credit, you can use that money to buy down an interest rate. And again, talk to your local lender like Shay that can help you do the math, whether it's worth it to buy down the rate. But there's also a lot of closing costs. Closing costs can range. There's title fees, there's taxes, there's real estate commissions, there's lender fees. Then there's a bunch of like little tiny weird fees that are, like there's some of them will put like mailbox fees and all kinds of stuff. So you really have to compare that stuff too. So when
Certainly.
you're looking at a closing cost, you can actually get a sheet and kind of go through it like, hey, what's this fee for? Like, oh, mobile notary. It's like, oh, well, I'll just come and sign in person and save $300 for the mobile notary. So, um, but I think you can actually roll in and I wish I had a title person. If you use those closing costs, you can put the cost of the inspections in there as well. So you can
Correct.
bill those through escrow, which helps cover. I mean, inspections are $500 to $1,000, for certain things. So if you want to go have inspections, and so uh, that's the advantage of a seller credit versus just lowering the price. Even though for the seller, the net price is still the same, and there's limits on those credits too. But like going back to your original point, we are getting more of those concessions. So maybe that means it's a buyer's market because uh, there's more I don't know if it's more advantageous, but yeah, it's advantageous to the buyer because there's more inventory and more choices for them versus like a seller's market, like we were saying during COVID. A seller's like getting 5 offers. There's no reason to take the one that they have to lower their net cost at the end. So
Yeah, sellers were oftentimes getting more than the asking price or the listing price,
yeah,
which
it
was
was crazy.
yeah. So let's talk about the current overall economic situation in the United States. So right now there's a lot of uncertainty and oftentimes, if I put myself in the shoes of a home buyer, which I own a home, you own a home, we've bought before. Right now, we're not currently looking to buy, but it is an uneasy time when you see prices either stagnant or maybe falling a little bit, but also you hear news every day, jobs are decreasing or there's layoffs happening or there's all these things going on that can strike fear into a buyer and that can make it really difficult a really difficult pill to swallow as a buyer. But what are some of the things so if you are a buyer that is needing or is wanting a first time you're a first time home buyer, you want your first home and you're willing to do whatever it takes. or you're a move up buyer that is looking to move from a home to a larger home or maybe downsize for whatever situation you're in. Maybe you had kids or maybe you had kids move out. Regardless, you're
Maybe
looking to change
maybe you
homes.
want more dogs. Maybe you want, you
Maybe you
know,
want more dogs in a large
maybe you want,
backyard so you can have your
yeah,
dogs run around.
yeah,
Exactly. Right
whatever
now,
reason.
the times are uncertain, obviously. And I wanted to ask you about this. Are you seeing that in uncertain times, that's when sellers are more willing to, if their situation is they need to get out, whether they need to pay off a mortgage or whether they have some other hardship that they need to take care of. If they're a seller and they really need to get out, are you seeing that in uncertain times, even as a buyer, that there is quite a bit more leverage there to get a deal done that's more in favor to the buyer?
Yeah, I think let's break that down like in a big triangle, upside down triangle. So like on a national scale, yeah, you hear about job losses. The government cut, hundreds of thousands of jobs. There's a lot of people that got furloughed, or basically they got paid not to work for the last 6 months. And so there's going to be more and more people looking for jobs. And I think the people that are really going to get hurt by that are the ones that are less experienced. And this kind of happened in 2009. I know because that's when I graduated college. Like nobody was hiring unless you had 5 years experience. And there's a whole pool of people that just got laid off with 5 years experience. So, just a basic supply and demand. There's a lot of people that already had experience. So why would they hire the person fresh out of college? Why would they do that? So there still is an experienced workforce out there that people are willing to hire. And generally, companies like to hire people that are not right out of college. There's pros and cons to both of that, but they'll take the person that they have to train less in general. And so, and there's the stock market's really inflated right now. There's a lot of investment in AI and what's going to go on there. I mean, AI is not going away. Uh, is this another .com bubble? Everybody likes to compare stuff to the past, but I think people have sort of learned from that. The companies are a lot more stable. There's not as many just sort of random startups investing. There's like huge companies, Microsoft, Nvidia, Apple. These are the companies that are really driving that. They say the S&P 500, but really it's the S&P like 7 and the S&P 94, 93. And so that's on the larger scale. And then on a smaller scale, and it really depends on what city and market you're in. Like looking at San Francisco, I'm going to use them as an example, versus a place like Norfolk, Virginia, where there's a lot of government workers. Like they're going to see a different housing pressure than they're going to see in San Francisco, where people are coming back to the market. It's like, okay, maybe we'll move back into that house we had. Maybe we'll just rent for a while, and then we'll start looking. And so there's just a population shift happening there. Same with Reno, a little bit in Vegas. Vegas definitely is a more fluctuating market than Reno, just because they built a lot more in the last, I don't know, 5 years. There was a lot more building in Vegas versus Reno. Reno's in this little valley and surrounded by government land and mountains, so there's not a ton of building. But each market's going to be a little bit different for the uncertainty that people have. In the Bay Area, a lot of people are coming back for AI tech, so there tends to be a little bit more certainty that like, yeah, they need me for this AI stuff. Versus like, if you're just out of college and you're starting a marketing job at a startup clothing company that sells on Amazon, that may be a little bit more uncertain there. Middle management, things like that. So it's going to be different for everyone, and that's where nobody really knows. I mean, these tariffs is another big thing that can affect a lot of stuff. And that affects a lot of smaller businesses too, or mid-size. If you work at a place that, yeah, maybe they're a $50 million company and there's only 20 employees, but they're very heavily leveraged in, China or someplace, or India. That was a big one that got hit. Um, and so that might create more uncertainty. So um, people still need a place to live, and there's a lot of rental places out there right now. And Reno rents haven't really dropped. They've been pretty stable. They just came out with a report that the vacancy rate is right just under 3% for Reno, which is pretty low for a lot of markets. Rental growth, rents, like the cost of rent, was pretty stable as well. yeah, Reno's not seeing this big decline. I mean, people want to move here for the taxes. They want to move here for the outdoor life. It is less expensive than California, but you still have some of that really great weather. We have Tahoe as well. So, I mean, there's a lot of factors that go into it, and there's seems like there's more of a, I don't know, wealth split going on. So if you're in the upper tiers, you tend to have more certainty. If you're in the lower tiers, there's a lot more uncertainty.
So,
Does that make sense? It was a long rant.
yeah,
Probably
wait.
because I had
So,
my
yeah,
coffee and you didn't.
bi- I know I haven't had my coffee yet, that's a no-no in my life.
Do you
I
want to
have
go
to have
get
my
some right
coffee.
now? Do you want to take a commercial break and
I should.
we can
Um,
probably, I could just pitch my company and that'll be like the commercial break we take in between.
Sponsored by Address
Yeah.
Income.
You
Yeah.
want me to play? I
So,
can just hold up a sign.
bottom line is, it comes down to the individual in your situation, and that's where talking with somebody that has got a moral, ethically straight head on their shoulders, that's not just trying to sell you on everything they see, is really important. Talking to somebody that really does want your best interest and will guide you, or help you make informed decisions so you can guide yourself in a knowledgeable way, is extremely helpful. So, Brad, is there anything else you want to touch on your end?
I guess, I mean, it's a pretty big topic for, is it a good time to buy based on the economy and everything else? A lot of people say there's a crash coming, but there's always a doomsday person happening. And there's always, if there's money to be made, especially in the stock market, people are gonna, as soon as there's a crash, like people are just gonna start buying again at a certain price. So the days of like these huge swings is, I'm not gonna say they're over, but there's a lot of computers now that look at stuff like that and prevent like these big sell-offs and things like that. Although it is interesting, Shay, that mortgage-backed securities, um, which is what caused the crash in '08. There's some news around that. Do you wanna touch on those? Like how Fannie Mae and Freddie Mac are no longer going to require credit scores for those
I
securities.
actually have been so busy lately, I haven't looked into it, so I can't touch on that right now intelligently. We'll save that for another
We'll say that for
episode.
another podcast. Yeah. But really, I guess it's kind of coming back to that. Like, if you want to make something work, you'll work harder to make it work, which is why rates are lower on primary homes than an investment home. So if you really want to make it work, people can make it work to buy, but don't kill yourself if you have to take like 9 Uber jobs and work 18 hours a day and sleep for two, and you have like a new baby at home, it's probably not advisable to be buying real estate. But again, it depends on your situation. If it's you want a house, you want to live there forever, and this is your dream house, then man, go all in. Like, and getting over the fear of making that commitment to buy no matter what your situation. That's where like talking to lenders can help. Talking to if you have a CPA, a good agent will also talk you through it, and they'll give you kind of they should be straight shooters. Like, yeah, this one's gonna be tough because it is. You do kind of get in this emotional, uh, I don't know, cycle where you kind of go through and you're like, it's scary, or it's like fun, then it's scary, then it's like, okay, this is not so bad. Then it kind of gets scary, and then hopefully you can make a decision on that. So
It's an extremely emotional decision. It's exciting at first, and then, yeah, the reality hits. You start going through the process of buying. There's all these things that have to happen. It takes 30 days. Then the
or
luster
longer.
starts to wear off, and then you're in it, and then you have to start making payments, and then you know, things start, yeah. So there's a lot that goes
Yeah, then
on,
it
and
gets
having
real.
people that can walk. Yeah, it gets really real. So, Brad, thanks for joining. I am
Thanks for
gonna
having
go
me,
grab a
Shay.
coffee. So enjoy your day. I'll enjoy mine. Anybody that's listening, enjoy yours too. And we'll catch you on the next episode.
All right. Thanks, Shay.
Thanks.
Bye.